There is a specific dollar amount inside every investment portfolio in America right now, calculable to the penny, where your money grows faster every single day than you could possibly save in an entire calendar year. Past that precise line, increasing your savings rate becomes mathematically irrelevant to your wealth trajectory. The machine does not need you anymore. Today I am going to show you exactly where that line sits, how to calculate your personal crossover point tonight, and why the 4 gateways between your current balance sheet and complete financial freedom are almost certainly closer than your spreadsheet currently tells you. Pop this number into sharp focus, $228,571. At a 7% average annual return, the moment a median American household crosses $228,571 in investable assets, the portfolio's autonomous daily compounding growth permanently surpasses the maximum amount that household could save in an entire year. For a household saving $40,000 annually, that crossover point sits at $571,428. Past either of those lines, the savings rate, the most celebrated, most obsessively tracked metric in personal finance, stops being the primary variable driving wealth accumulation. The machine has outrun the human. And the data proves this with exact, unambiguous dollar precision that the standard savings rate conversation has never bothered to calculate. Before we build the 4 gateways, we need to surgically dismantle a number most people trust without question. Total net worth. The Federal Reserve Board Z.1 Financial Accounts of the United States, the most comprehensive survey of American household balance sheets in existence, separates total net worth into 2 categorically different asset classes. Financial assets, stocks, bonds, retirement accounts, and income-generating instruments. Non-financial assets, primary residences, vacation properties, vehicles, and durable goods. For the median American household, non-financial assets represent 67% of total net worth. Only 33% sits in productive financial assets generating actual cash flow. On the left side of this comparison stands the median household, 33% productive. On the right stands the top wealth quintile, where 71% of net worth sits in productive financial assets. That ratio inversion is not accidental. That ratio is the wealth gap. The number on your net worth statement and the number that actually funds your freedom are separated by one question: how much of this generates cash flow without your labor? A vacation property valued at $800,000 with $24,000 in annual carrying costs, property taxes, insurance, maintenance, HOA, delivers a productive internal rate of return of -3% before accounting for the opportunity cost of the capital locked inside it. That is a monument wearing an asset's name. All figures presented here are for educational illustration purposes only, and nothing in this analysis constitutes personalized financial advice. Individual outcomes depend on specific tax situations, risk tolerance, and personal circumstances. Consult a licensed fee-only financial planner for guidance specific to your situation. Now the framework. There are 4 mathematical gateways between your current balance sheet and complete financial freedom. Each is a specific portfolio size that generates a specific monthly cash flow permanently. Gateway 1 is financial stability. The machine covers core necessities, housing, food, utilities, essential transportation, approximately $3,000 per month, or $36,000 annually. At the 4% withdrawal rate established by the Trinity study at Trinity University, the required machine size is $900,000 in investable assets. At this stage the portfolio is growth-oriented, 80% equities, maximum contribution rate, full-time horizon advantage. Gateway 2 is financial security. The machine covers your complete lifestyle and every recurring expense. Approximately $6,000 per month, or $72,000 annually. Machine requirement, $1.8 million. The portfolio here transitions toward a 60-40 balance. Dividend-producing equities and bond instruments begin building the cash flow layer beneath the growth engine. Gateway 3 is financial independence. The machine fully replaces your earned income. Approximately $10,000 per month. Machine requirement, $3 million. The portfolio's primary function shifts to reliable yield, dividend aristocrats with 25 consecutive years of dividend growth averaging 2.5 to 3.1% yield, REIT distributions averaging 4.2%, Treasury bond ladders at 4.5 to 5% with zero credit risk. Gateway 4 is financial freedom. The machine funds your complete life vision, legacy giving, and generational architecture. The number is personal. The calculation is identical. But read every gateway figure with extreme care, because the Morningstar Investment Management's 2023 empirical analysis of sustainable withdrawal rates delivers a direct challenge to every framework still running on the 4% assumption. At current market valuations, Morningstar's research establishes that a 3.3% withdrawal rate, not 4%, is required for a 90% probability of portfolio survival over 30 years. That single decimal point pushes Gateway 2 from $1.8 million to $2.18 million. Gateway 3 from $3 million to $3.64 million. The survival probability curve drops steeply past the 4% line. And almost no content in this space is updating the Gateway mathematics accordingly. Now the most corrosive misconception in personal finance. DALBAR's annual quantitative analysis, tracking the actual realized returns of millions of American investors across 25 consecutive years, reveals a structural behavioral gap of 2.84% annually between what the S&P 500 delivered and what the average equity investor actually captured. On a $300,000 portfolio over 20 years, that behavioral gap costs $412,000 in foregone compounded wealth. Compare these three impact bars directly. Increasing your savings rate by 1% adds approximately $123,000 over 20 years. Eliminating the behavioral return gap adds $412,000 over the identical period. The variable receiving maximum optimization attention from the personal finance ecosystem delivers 3.35 times less impact than the variable most investors never track. This is not opinion. This is 25 years of actual investor return data from DALBAR's longitudinal study. At Gateway 1, $900,000, a 7% annual return generates $63,000 per year in autonomous portfolio growth. That number already exceeds the entire annual savings capacity of the median American household. At Gateway 2, $1.8 million, autonomous growth reaches $126,000 per year, which is 3.15 times the maximum savings of a household earning $80,000 and saving 20% of income. At Gateway 3, $3 million, the portfolio generates the equivalent of 2.6 average American annual salaries every single year in autonomous growth, without a single additional contribution. Follow the compound growth curve as the portfolio crosses each gateway threshold. Notice the slope steepening at every milestone, because the compounding base grows larger at every milestone. This mathematical acceleration is invisible to most investors because they are still measuring their savings rate instead of their portfolio's autonomous growth velocity. Coming up in the next segment, two portfolios with identical 30-year average returns. One survives to $1.8 million. One depletes completely at year 22. The difference is not the return rate. It is something almost nobody in this category is currently addressing. Dividing this analysis into two halves. Portfolio A and Portfolio B both enter retirement with $1 million. Both maintain identical 30-year compound average returns. Both withdraw 4% annually. Portfolio A receives its strongest returns in the first decade. Portfolio B receives its weakest returns in the first decade. Follow Portfolio A's trajectory, it reaches $1.8 million at year 30. Now follow Portfolio B's line, it crosses zero at year 22. The mechanism, forced withdrawals during declining markets, requires selling more shares at depressed prices, permanently reducing the share count available to participate in the subsequent recovery. Research from William Bernstein and Michael Kitzes demonstrates that the first decade of retirement returns determines portfolio survival with approximately 80% predictive accuracy. The solution is a 2-year cash buffer in short-duration instruments, eliminating the forced selling mechanism during market contractions without requiring any market prediction. Now watch the Gateway 2 threshold collapse in real time. The $1.8 million machine requirement assumes zero Social Security integration. The Social Security Administration's 2024 actuarial data establishes that a married couple with both spouses claiming at age 70 receives a combined average benefit of $4,578 per month. The Stanford Center on Longevity confirms that delaying Social Security from age 66 to 70 generates an effective guaranteed 8% annual increase per year of delay, the highest certainty return available in any financial instrument in America under current law. When $4,578 per month in guaranteed income is applied against the $6,000 Gateway 2 requirement, the investable machine only needs to cover $1,422 per month. Machine requirement, $426,600. Not $1.8 million. For many households in this room, Gateway 2 is not decades away. The claiming strategy decision, made once, rarely revisited, is worth more than a decade of maximum 401k contributions. The final mechanical layer is the shock absorber. JPMorgan Chase Institute research analyzing 6 million actual household bank accounts established that households maintaining liquid savings equivalent to 6 weeks of income experienced 74% lower probability of financial hardship during income disruption. The optimal reserve scales directly with income volatility, 3 to 4 months for salaried employees, 9 to 12 months for self-employed professionals with variable revenue streams. And a $75,000 reserve positioned in a high-yield savings account at 4.75% generates $3,562 annually, transforming the emergency buffer into a productive sub-asset within the machine architecture. Here is the complete calculation sequence. Step 1. Calculate monthly necessities to find Gateway 1. Step 2. Calculate your complete monthly lifestyle to find Gateway 2. Step 3. Calculate your full monthly income to find Gateway 3. Step 4. Subtract your Social Security offset from each threshold. Step 5. Divide your annual maximum savings capacity by 7% to find your personal crossover point, the precise portfolio size where autonomous growth permanently outpaces your savings rate. 5 inputs. Your complete wealth machine blueprint now exists and is calculable tonight. Understanding this architecture addresses accumulation mechanics. But the sequence of returns threats currently positioned against this system in today's rate and valuation environment, and the exact defensive configurations that neutralize them, extend well beyond what a single analysis can contain. The most consequential financial traps set for retirement assets right now are mapped out in the analysis linked here. The number of those traps your current portfolio is exposed to is a calculation worth completing before the market opens tomorrow.